It is Friday, February the 27th. Hard to believe February's almost over. Next week with our video, it's obviously going to be March, and just was reminded this morning in a newscast that next Sunday, not this Sunday, but next Sunday, we spring forward, so we'll lose an hour, but we get light at the end of the day, a longer day to work.
Not dark at 6.
You know Trace Weatherford, one of the three new amigos here in the great merger that's underway with TRPG and HMC, and we're so pleased. Trace, glad to have you.
Thank you.
What a week it has been for a lot of data.
A lot of news.
Lot of news.
Yeah.
First of the week was the president's historical longest speech. You knew he was going to set a record and he had the longest speech. If you were to highlight the top two, maybe three things that came out of it from an economic position that could potentially affect the stock market, what would you say they were?
I think his biggest addresses were just talking about the price towards consumers. So speaking about gas has dropped, maybe not as much as he indicated, but prices are down there. And then the same with inflation. Again, maybe not as much as he made it seem to be, but January did show cooling when it comes to consumer pricing index.
I also was taken back a little bit, maybe wondered how the power companies were taken aback, but an economic potential effect. We all know about artificial intelligence. We've been talking for a year that the utility sector is an area to be in because of the demand. But he came out in this speech and said, "Okay, boys, if you're going to build these big behemoth power structures that we got to have, you're going to be paying for the power structure to get built, and it's not the government's or the people's obligation." And interesting enough, other articles later the week, the AI companies, they got enough money there. They have the ability to do that. The final thing that came away in a lot of things that were being said in the speech, we all know that we got to keep our eye on what's happening in the Middle East, in Iran. And a conflict involving Iran and us would not be good for the market. So watching that. This week also was interesting in that CPI information came out that indicated it was a smidge bit hotter than they anticipated, but not as hot as they thought it would be.
Yeah. No. Well, PPI came. That was this week as well, and that producing costs of it, that was way high just from this increase in service costs to do so. But in a year over year, it was less than a percent that was up for consumer. Yeah.
So you're getting mixed messages there. You had the 10-year Treasury note drop below 4%. Now, the immediate counterbalance to that was mortgage rates then dropped. 30-year mortgage rates edged down right below 6%. So a good piece of information in the 10 years affected the mortgage rates, which are building and stimulating from that. Now, let me caution you from the 10-year. At the same time, another piece of information this week that might be a little bit puzzling, NVIDIA came out with its earnings.
Beat expectations.
Knocked it out of the park.
Yeah.
But what did the stock market do?
It dropped 4%. Well, NVIDIA itself dropped over 4%, and then the stock market as a whole went down a little over 1%.
And that has to do with the pricing and overpricing and in the saying of getting ahead of their skis, the technology sector and all being overpriced. All right, so let me see if we can put this all together. The 10-year Treasury drops a little bit more below 4. Now, it drops because money goes to it,
Yep.
okay? And money goes to it because it's considered a safe haven.
Yep.
We had a sector, technology, and the major company hit its numbers out of the ballpark, but its stock dropped. So there is obviously a shift in the market right now of how much is the correct percent of a portfolio to be in technology.
Yeah.
And we had an interesting question on our radio that asked that very question. Let us summarize. Technology should always be some part of your portfolio.
Mm-hmm.
It's here to stay. But we do believe it's shifting, and it should not be a major, heaviest part. It ought to be more balanced. And we've been working with our clients getting portfolios
Doing just that.
more balanced.
And I think the consumers as a whole, even retail investors, are starting to realize that, yeah, having the S&P 500 overweighted in a sense 40% in the Magnificent Seven, which are mostly technology-based companies, probably isn't going to be the best thing. That's in a way putting more eggs in that basket than may be needed.
So what we are doing is as we meet with each one of our clients and reach out and do a review, we're looking at the overall weightings. We're looking at the overall positions. We're making rebalancing. We're taking some gains where there has been accessible big gains in technology and rebalancing. We're taking advantages of losses for tax purposes, and we're helping rebalance at this point in time. We still believe 2026 the market's going to be up. We still believe it's going to be bumpy to get it up, but we think a rebalancing, it makes sense. And when we call to set up the appointment, that's what you'll see us doing from everything we're doing. Anything else from your end, my friend, as we go into a new month?
As you always say, seatbelt sign is on, drinks are going to be served, and just enjoy the ride.
Enjoy the ride. We do this each and every week because we know it is your money.
And your money matters.
You
Take it from me.
You
Don't
got
take
it. You got it. All right. We'll see you next week.